Hey traders, Raghee here, and in this recap video I'm going to do another trade breakdown. I got a lot of good response and replies to yesterday's Euro-Yen conversation. So I want to dive into the Dow here because this is a futures breakdown we're going to do right now. Now on the, I think Tuesday, it would have been Monday or Tuesday, so the 23rd to 24th this week, I sent out a text alert talking about the 480, 240, 180, and 120 minute. In other words, these time frames, the longer term intraday time frames of the Dow. And we pinpointed a level that made sense across all of these time frames. At the time, back on Monday or Tuesday, every one of these longer term intraday time frames could absorb a move down to 23,200 and still maintain their validity. In other words, still maintain a swing by staying above the 34 EMA on the low on those respective charts. So when you're looking for a longer term time frame to trade in lieu of the daily, because you want to take advantage of a more shorter term correction or more shallow correction, and you need an alternative to the daily, which has just been really a runaway market, you'll turn to these longer term intradays. And then I'll calculate what a level would be that one could be exhaustion, and then two, the market's got to be able to absorb that level without breaking, in this case, a 34 period exponential moving average on the low. That's the first thing. That's where the heavy lifting comes in, doing that very simple but very necessary number crunching. And then we put out an alert. So we text out, all right, these four time frames look good from this price level. Now you might ask, okay, Rog, what if I took the 480 versus 240 versus 180? What's the difference? The stop is really the difference, the stop loss. Because on the 480 minute time frame, you can take the trade really through 23,080 into about 23,065 as a stop. On the 240, however, you're really only able to tolerate a move through, say, 23,200. So we're talking about 120 or more points between the stops on both these two entries. Because while the entry is the same, the validity for the trend is what sets the stop. And the 240 minutes is going to have less tolerance for risk. So you might say, well, if I'm lower risk tolerance, does that mean I should trade a shorter term time frame? Absolutely. But when you really have a terrific setup, you still have that shorter term time frame able to absorb upper end volatility, which is exactly what we had this week. And we were able to execute an entry on the YM contract, the December contract, for the Dow from 23,205 to 10, and then ride that up higher now to 23,345, which is where it's sitting right now. Now, here's the other part of the setup. We move the stop to a break even. In other words, if for whatever reason we were just to melt down tomorrow and slice down through 23,200, my stop would be waiting at 23,195. I don't want to let this winner turn into a massive loser. Therefore, I use a break even, not mathematically a break even, but in the spirit of protecting my capital and really only risking unrealized profit. But realize too, by now hitting two profit targets, I have reduced my position size by taking a lot or two or whatever you're comfortable with off at each profit target. So as we progress with this trade, my risk is reduced because my position size is reduced. And that is a breakdown currently of the YM, the way we got in, and what we're managing right now.